Hi, everyone. Good evening. I'm going to go ahead and get started. My name is Sarah Montijo. I'm delighted to welcome you to our financial relief webinar. We've had a team working diligently over the last few weeks to pull together meaningful information so that we may serve as a resource to our partners in the community. We're grateful for the speakers joining us. They have volunteered their time to be with us during what is a busy period for them too. With us this evening, we have Ann Kelly, Chief Credit Officer with North Star Financial Group, Greg McNeill, Shareholder General Counsel and Chair of the Litigation Department with Lowndes, Andrew Gluck, also a shareholder in the Leasing Practice Group with Lowndes, and Rachel Gebaide, Shareholder and Chair of the Labor and Employment Law Group with Lowndes. A few logistical items before we get started. Each speaker is going to present for approximately 10 minutes. After each presentation, we'll have 5 minutes for question and answer before moving to the next topic. As an audience member, I encourage you to ask questions, and you may do so by typing your question into the question and answer feature in Teams. I'd like to note that our speakers will not be giving personal business or legal advice this evening, so please keep that in mind when asking your questions. And lastly, while we enjoy positive relationships with both organizations represented here today, the opinions they share this evening are their opinions and do not necessarily represent the position of Advent Health. That's our small print official legal disclaimer. So on the next slide, with that, I'm going to turn it over to Ann Kelly to kick us off. Ann.
Okay, Sarah, thank you very much. I'm going to talk through some of the loan opportunities as far as navigating through this cash flow crisis resulting from COVID-19. In the way of background, the Paycheck Protection Program, which we refer to as PPP, created by the CARES Act, is an SBA-sponsored program in response to the COVID-19 crisis. The program is designed to try and keep employees on the payroll or bring back employees that a business had to let go due to business disruption caused by the virus. The funding is to assist small businesses that primarily have under 500 employees. The program is administered by banks and qualifying financial institutions. Given the sheer magnitude of the SBA program, they had to enlist financial institutions to underwrite, fund, and administer these PPP loans. And as everybody knows on the phone, the banks had virtually no time to get these programs up and running, even some of the preferred SBA lending institutions. The first $349 billion from the PPP program was used up last Thursday after only 13 days. The next round of funding is expected to be $320 billion. And this should be passing through the House as we speak. I've been kind of keeping my eye out to see if it's passed through yet, but it'll be probably within the hour. And they are reserving $60 billion of the $320 billion, essentially for large and small community banks, and then certain size credit unions, just to make sure that everybody has an equal shot of helping their customers and that it doesn't all go right to the big banks for very large customers, because these loans can go up to 10 million. And as we all know, most small businesses don't need that much to get them through this crisis. This will ensure that all the funding, as I said, doesn't immediately go to the large banks right out of the gate. It should open up. It could be as early as tomorrow. It may be Monday. We won't really know. We get very little notice from the SBA as to when they're going to pull the trigger. Now that all the banks have been able to set up their processes and procedures, it is expected that this next round of PPP funding will go quickly. There are applications pending. Many of you may be in that camp where it didn't make it into the first round of funding because the day they were out of funding, it just it stopped that particular minute. So what will happen is the banks will most likely submit those applications first that are already in the queue. You won't have to do a new application, and then they'll be accepting new applications for C Corps, S Corps, sole proprietors, and partnerships. So sole proprietors and partnerships, that just opened up a week ago, but quite frankly, the money had already been used before that group of customers, as a general rule, could see any benefit. Primarily, banks will accept applications from their existing customers first because it's not just their loan customers that are applying, it's also deposit customers that don't have any loan relationships. So there's quite a lot of customers that see an opportunity to try to get some of this funding. Non-bank lenders are accepting applications from their customers as well as prospects. And I think during this round of funding, because the banks have mobilized better, I mean, we had a little bit more notice, they will take on some prospects for this second round of funding. And that'll be on a limited basis, but that may help some of you that are dealing with, I won't mention any names, but there are some large institutions that were capped on what they could do for their customers, or just, really were not able to help very many of their customers at all. Essentially, the new round of funding for the PPP program should mirror the eligibility requirements in place for the first round of funding that closed out last Thursday. And just to highlight a couple points, the loan amount is 2.5 times the amount of the business's eligible payroll costs. And you'll have 8 weeks from the day the loan actually is funded. That's a question that comes up a lot. Not approved, but actually funded, where you receive the proceeds. That's when you start the 8 weeks to spend the loan proceeds on eligible expenses. The loan is forgivable. It'll be treated much like a grant would be if you spend at least 75% of those loan proceeds during that 8-week period on payroll expenses. Again, the whole intent of this program is to try to get people back on the payroll or keep them on the payroll. And then 25% of the loan proceeds can be used on other expenses such as interest, rent, utilities that you're incurring during that 8-week period. There are very specific guidelines for the forgiveness part of the loan, and there are now some good loan calculators out there to help guide you through what is forgivable and what is not. I am a math major and have an MBA, been in banking my whole career, and I got to tell you, it's going to be a bit complicated. So a lot of customers have actually set up a separate bank account and they've deposited the loan proceeds into that account, and they're just being very strict about how they spend the money if they want it forgivable. I can provide a loan forgiveness calculator if anyone needs one. My email and cell phone number is, I think, on the slide, so reach out if I can help you there. If the loan proceeds can't be used for the intended purposes of just payroll and the other eligible expenses that I mentioned, the loan isn't forgivable. But as a banker, I can tell you it's the most favorable loan terms you will ever receive. It's a 1% fixed rate. Your interest is deferred for 6 months from the day you receive the loan proceeds. The loan is then paid back over 18 months, so it's really a 2-year loan. The loan doesn't carry a personal guarantee, nor does it require any collateral. So let's just say you can't use the loan proceeds to bring people back on your payroll. Your business isn't quite open yet the way you need it to be. You need to save that money until you can get your employees back and essentially almost start back up again. You have 2 years to pay that loan back at 1%. You can pay it off early. There's no prepayment penalty. There are some other SBA direct loan programs out there to assist small businesses. I will say they have been frustrating and confusing for almost everybody that's applied. Some of you have probably applied numerous times, and those are the economic injury disaster loans. They did run out of funding, but there may be more funding with this new bill. And the Main Street Lending Program. Those are direct programs from SBA. SBA systems, much like the unemployment situation, their systems are overwhelmed, and those loans do carry more restrictions than the PPP loans. Those are not forgivable loans. So what else is available from your bank? Payment deferrals is another option, and really all banks are looking at least offering 3 months of payment deferrals of your principal and interest on your amortizing loan payments for, let's just say, your equipment, your buildings, or other term loans. Some people are just moving to interest only, but a lot of banks are waiving the principal and interest, and you just start back up on the 4th month and resume the normal payment. You don't really have to catch it up. It's the normal payment. I think a lot of banks will go out to 6 months if you need it. They won't look at you like there's a problem there. It won't change your relationship with the bank. It's a different time I see as far as how the regulators are handling the banks than back in 2008, 9, and 10. They are being very accommodating and encouraging the banks to be accommodating. And that was really not the case back in the 2008 through 10 range. If you haven't done this already, you may want to wait to have the whole principal and interest deferred, because if you get that PPP loan I mentioned, if you're in the queue to get one or you already have one, part of the forgivable loan proceeds can go toward the interest costs on your mortgage loan. And so waiving both principal and interest, you won't be able to count that interest in the 8 weeks. If you just move to interest only on your loan, you can write that interest off. So you may want to wait, like I said, to ask for a full deferral until maybe a couple months out. And I really feel that banks are going to be very flexible about doing that. In addition, this kind of flew under the radar. If you currently have a SBA 7A loan or an SBA 504 loan, many of you may be familiar with that if you bought a building or purchased equipment, refinanced equipment. In most cases, if you're in good standing with those loans, the SBA is offering to pay the loan for you for over the next 6 months, not defer it, pay it. And so the SBA will pay the bank if you have a 7A loan, or they'll pay the debenture. That's what your 504 loan turned out to be when it was sold in the secondary market. They'll pay 6 months of those payments, and it does not impair your relationship with the bank or the 504 debenture. And you'd work through your bank to find out more about that option. Let me just mention lines of credit. Another option is to ask for a temporary increase to your line of credit. If you have one set up with the bank, you may already have that established. A lot of banks are offering a 10% overline, really with very little paperwork to assist borrowers with a cash flow crunch. We've seen borrowers in the medical profession that haven't used their line, but they came in and asked for an increase to their line just to help them through this period of time. Short-term bridge loans from your bank. Let me talk about that. Finally, the medical industry, it's generally considered to be a very highly desirable industry for banks to lend to, even given the severe drop-off in revenues and profits due to the virus. In most cases, banks recognize that medical professionals are just deferring their revenues until they can see patients again or perform elective surgeries that they've had to put on hold. So bankers know that cash flow will return. It just may take time to ramp up revenues and return to profitability. And as a result, you most likely can obtain a bridge loan from your bank to help provide cash flow over the next year that normally would carry a personal guarantee and either personal or business collateral. But again, it's a highly desirable industry for banks, and I think the opportunity to get these bridge loans would most likely exist for most of your banks. So that's the end of my formal presentation, and I'm happy, Sarah, to take any questions that anyone might have.
Excellent, Anne, thank you so much. A lot of material unpacked in a very short period of time, so thank you. That's an excellent job condensing it. We have had one question come in and came in the relatively beginning part of your discussion. The question is, does payment deferral affect your credit score?
It does not. That's a very good question. And it doesn't on the consumer side either. So if you have a personal house mortgage as well as the business mortgage, the deferrals are not going to count against your credit. It's going to be accepted in the industry that because of the virus, this is an unusual situation.
Excellent. Thank you. Thank you very much. Okay, in the interest of time, we're going to move to our next speaker. And thank you again so much for your help and time with us this evening. Next up, we have Greg McNeill, and Greg, we're going to turn it over to you.
Thank you very much. My topic tonight, and I'll move quickly because it's a lot to cover in a fairly short time, is business interruption insurance. So what is that? If you are a business owner, you probably have a property policy, a business property policy. And if you have a business property policy, you almost assuredly are going to have something in there called business interruption insurance, and it's for business income that is lost as a consequence of some insured event that occurs. So the question is, typically people think of business income insurance. If there's a fire, it burns the building down. If there's a hurricane that substantially damages the business and you're out of business for a while, you're going to lose income, and the insurance is there to handle that. And that's typically how we think of business interruption insurance. However, we are in a unique time right now in this environment. And the question that we have been advising clients on, and the question that has started to come up over and over again, is what about coverage under that part of the policy related to lost revenue because of government shutdowns? COVID-19 has obviously affected a number of businesses who have been forced to close and have remained closed for some period of time and have obviously lost business income as a consequence of that. So what about that? Is that the type of loss that might be covered by your business interruption insurance? Now, when you look at your policy, and probably most people haven't looked at their policy, and we'll talk about that in a minute. But when you look at your policy, you will see that the language which is used typically is income or losses that arise from a direct physical loss or damage to the property. And that's why we think of fires and hurricanes when we talk about direct physical losses or damages. But it has been the case as the courts have construed these policies around the country over the years that it may not require a direct physical loss or damage to your property. For example, today, and if we're talking about COVID-19, which is at the top of everyone's mind, obviously you could have an actual viral contamination of your business premises. And that's one scenario. That's not very common. The more common scenario is that your business is closed because of governmental shutdowns. And as a consequence, you've lost the revenue. So the first question is, for a business owner, do you have a business property policy? I'm going to guess that everybody on the call has a business property policy. I'd be surprised if you didn't. The second question then is, does that policy contain coverage for business interruption or business income interruption? It's very likely it does. That's where you would normally find it. So now, a caveat, all policies are contracts, like any other contract. So it matters what your policy says. And while there are similarities in policies, there are also differences. For example, some business property policies are called all risk policies, which means that unless the risk is expressly excluded, it is considered to be included. So what matters, the first takeaway from what I'm going to tell you tonight is you have to have a copy of your policy. Most policyholders don't. You have maybe a certificate of insurance that just tells you generally that you've got coverage and you've got a certain amount of money in coverage, et cetera. That's not any good. That won't help. You may have a summary of coverage that your carrier helpfully provided you, which is just what it says. It's a summary. It sort of generally describes the coverages you have. That doesn't help. Those are summaries. You need a copy of your full policy, and your insurance carrier is required to give you a full copy of your policy. So you would want to ask your carrier or your carrier agent, I need a copy of my full business property policy, because that's the starting point for determining whether or not you might have coverage for COVID-19 shutdowns. And the $64,000 question for those of us who are old enough to remember that old show is, will a government shutdown trigger business interruption income coverage? And the answer is a resounding maybe. Now, insurance companies and their agents will tell you no. It is not the type of physical damage or loss that is covered. They're already out there. They've gotten in front of the story. They are driving that narrative. They've been out there for a while. They are at every opportunity writing, speaking, talking in the industry that this is not the kind of thing that would be covered under a business interruption. And for most people, if they think about it, they say, well, direct physical loss or damage, I didn't really have a physical loss. I didn't really have any physical damage. My business was just shut down because of the governmental order. But the thing to remember is anytime an insurance company and a policyholder get into a dispute about coverage, there are two principles that apply. Number one, if the policy is susceptible to more than one interpretation, in other words, if it's ambiguous, the courts will rule in favor of coverage. They will rule in favor of the policyholder. Tie goes to the policyholder. The second point is that courts tend to construe provisions and policies which grant coverage very broadly, and they tend to construe exclusions from coverage very narrowly. So going into that, you have sort of two steps up on the insurance company. So against this backdrop, and even though there's very little case law out there, there have been very few court decisions to date, as you would expect, because COVID-19 is so new. We just don't have much information about whether or not this type of coverage is going to be available under business interruption. But I can tell you that if you look around the country, there have been a lot of cases where courts have found coverage that didn't look like it really involved physical loss or damage. For example, Pennsylvania, there's a case where there was coverage because there was some contamination in a water supply. In California, there was a bar and tavern that had tainted well water, and there was coverage under, even though there was no damage to the property. In Virginia, an airline sued for coverage because when 9/11 happened, they couldn't get their planes in and out of National Airport. There was no damage to the planes. The planes were fine, but they were interrupted in their ability to do business, and there was coverage for that. In Oregon, there have been cases that have found coverage for mildew exposure. In Colorado, there's a case that deals with gasoline that was underneath a building, and it didn't harm the building, it didn't cause damage to the building, but it made staying in the building potentially dangerous, and there was coverage. In Louisiana, there was coverage for lead intrusion. In Minnesota, there was coverage where asbestos was present, even though the people who were occupying the building didn't leave. They stayed in the building. They remained on the premises. So there was no actual damage to the building. One of my favorite cases out of Oregon, a guy got coverage because his next door neighbor was cooking methamphetamine and the odors were bothering the guy who was running a business. And the odors were bothering his business. They found coverage because of the noxious odors from methamphetamine. And in West Virginia, a business recovered where a next door neighbor had a rock slide that affected their business, but it didn't actually bother the business of the insured, and they found coverage because of the potential for danger. So the point there is that courts around the country have, in many cases, found coverage under policies where you didn't have the traditional sort of physical damage. The point, though, in all that is this is an issue which is brand new. It's going to be heavily litigated. There is no question about that, because we are talking about hundreds of billions of dollars that are at stake in these kinds of cases. And the suits have already begun. New Orleans, there have been a couple of restaurant companies that have filed for COVID-19 shutdowns. Just recently in Fort Lauderdale, a restaurant filed a lawsuit against Chubb for business interruption coverage because of their government shutdown. Some state legislatures have even toyed with the idea of passing laws that require business interruption coverage to pay for government shutdowns. Now, that raises all sorts of constitutional issues, which we don't have time to get into. But the point is, this area of the law is changing very rapidly, and it is difficult to predict right now where it's going to go. You may have other types of insurance coverages under your policy that you don't even know about. One's civil authority coverage, where there's a shutdown because of a government order. Contingent business interruption, where an adjacent property has an issue, or a vendor or a customer have issues which impact your business. ingress, egress, etc. So the starting point, again, if there's one takeaway from all this, is you have to have a complete copy of your policy, both the policy itself and all the endorsements. And endorsements are just a word that lawyers made up for amendments. It's just like add-ons to your policy. So my advice in the 10 minutes that I had tonight is that you need to get your policy. You need to have it reviewed by someone that you are comfortable, knows what they're looking at, and knows what to look for. And if you believe there's a chance you have a claim, make it. There's no downside to making a claim. In fact, the sooner you make the claim, the better, because if you delay, it can impede your abilities to make a recovery on your policy. So get your policy, have it reviewed, and if there's any basis for making a claim, go make it. And that's my 10 minutes.
Excellent. Greg, thank you so much. That was valuable information. I've learned that I need to give a little bit more time for questions to come in. So we'll wait just a minute to see as questions come in here.
Okay.
While we wait there, Anne, are you still on? Do you mind if we circle back maybe to one that came in after Greg and I started on his topic?
Sure.
A follow-up question to the payment deferral going on a credit report. Would it show up as a footnote on your credit report?
No. The bank, well, first of all, if it's a business-related obligation, most banks don't report to the credit bureau on anything that's business-related or commercial-related. If it's personal, so let's just say we're talking about your home mortgage. Again, all banks have been advised to stand down on payment deferrals that are COVID-19 related. And so if for some reason the bank messed up on that, they will go in and correct the credit bureau. And that is, that is a big concern, I recognize, but that is the whole intent, is that these payment deferrals will not affect credit.
Excellent, thank you. Greg, a question for you as audience members who may not have business interruption insurance today. What advice would you give them for thinking about something like this in the future, and when might be the right time to seek such insurance?
Right, that's a good question. If you don't have business interruption insurance, the likelihood is that you don't have a business property policy, because that is the general policy where you find that type of coverage. Typically, business interruption coverage is not a standalone policy. So that's the reason when I was talking earlier about the fact that if you do have a business property policy, which covers all sorts of different perils, you more than likely have business interruption coverage already. If you don't have a business property policy, then I don't think that there's any reason that you wouldn't go out and get one as soon as reasonably possible. Again, there are risks that are covered by the property policy that have nothing to do with business interruption, and are going to be valuable. Certainly if you have any financing on your business, the lender is going to require that you have a business property policy. So chances are you have one, and chances are that policy already has business interruption coverage built into it.
Very helpful. Thank you so much. We'll pause for just one more minute and see if any other questions come in. Okay. Thank you, Greg. Very much appreciate your time with us this evening.
Okay. Thank you. Bye-bye.
Thank you. Bye-bye. Andrew, welcome.
Thank you, and good evening. It's a pleasure to be here. As mentioned, my name is Andrew Gluck, and I'm a shareholder with the Lowndes law firm. My practice centers on commercial real estate transactions with an emphasis on commercial leasing. In particular, I have a lot of experience negotiating leases for medical office buildings. Due to COVID-19, I've been spending a lot of my time negotiating lease workouts for rent relief, and I'm here today to share some insights. Let's start with the second slide, preliminary considerations. First off, confidentiality. If you are the landlord of a multi-tenant medical office building or multiple single-tenant buildings, you probably don't want your tenants sharing information with each other. If you are a tenant, You might be concerned that the landlord will share your financial information. Consider entering into a non-disclosure agreement prior to negotiations and adding confidentiality language to the eventual documentation. A second preliminary consideration, existing financing. If the property is subject to a mortgage, the landlord first needs to understand what terms, if any, can be amended without the lender's consent. This also applies to tenants with leasehold financing. To the extent your lender has consent rights, you will want to get them involved early. Landlords and tenants also need to think about whether any third parties like ground lessors or affiliated hospitals hold consent rights. In addition to consent rights, loan documents often contain other covenants that could be impacted by a lease workout. For example, debt service coverage ratios. Conduct a thorough review of your loan documents before engaging in any lease workout negotiation. Involving your attorney in this process is not a bad idea either. Moving on to the next slide, please. Tenants should be prepared for landlords, lenders, and any other third parties with consent rights to request financial information. The form and extent of this is often negotiated, but some documentation of financial need is typically provided. While on the topic of documentation, let me take a second to discuss the options for documenting the eventual agreement between the parties. I highly recommend a formal lease amendment. However, a side letter can be used if the terms are simple enough. Verbal or handshake deals are not recommended. In Florida and in many other jurisdictions, a lease for more than 1 year must be in writing. With that said, let's move on to the next slide. Rent relief. But what does that look like in the marketplace? I must warn the tenants out there that straight up free rent is not very common. In most cases, I'm seeing some form of rent deferral with three main options. One option is repayment over the remaining lease term or a shorter period. Either way, interest is typically factored in. The second option is repayment in a lump sum at the end of the term, also with interest factored in. The third option is a month-for-month extension of the lease term for each month of current rent abatement. Most deals I'm working on involve abatement for some part of April, May, or June, with repayment over a 6 to 12 month period starting in 2021. If there's a security deposit, some landlords are agreeing to apply the security deposit to current rent payments in exchange for an obligation to replenish later. Another factor to consider, operating expenses or additional rent. In most cases, tenants are being asked to continue paying all operating expenses and any additional rent required under their leases. Obviously, this is negotiable, but I haven't seen many landlords willing to give on this. In all circumstances, the tenant will still be required to comply with all other terms of the lease. Next slide, please. Now that I've covered the basic terms of the lease workout, I want to address some additional considerations from the landlord's perspective. What should the landlord seek in return for providing rent relief? First, a landlord should seek a blanket waiver of force majeure and impossibility defenses related to COVID-19. Without delving too deep into these legal doctrines, the basic concept here is that COVID-19 and the related government shutdown orders act to relieve the tenant from its obligations under the lease. While it's arguable whether these defenses are applicable in the first place, the landlord does not want to provide rent relief now and later find themselves in a legal battle over these issues. Second, the landlord should seek broad indemnification for third-party COVID-19 claims due to any possible spread at the premises. Next, a landlord should require the tenant to comply with all CDC guidance related to COVID-19. Finally, the landlord should require the tenant to pursue any legitimate business interruption insurance claims, as well as any available government relief. Next slide, please. Although less material than the previous items, here are some additional items to consider. Increased tenant financial reporting obligations, adding personal guarantees to the lease, bankruptcy protections, and other remedies if the tenant defaults. These changes may be unpopular with the tenant, but they can provide the landlord with meaningful protection should the tenant not recover. A landlord may also want to remove special tenant rights like expansion options, early termination rights, permitted assignment or sublease rights, self-insurance rights. This is not intended to punish the tenant, but rather to protect the landlord. In some circumstances, a landlord may need to place new restrictions on the use of the building common areas and potentially modify the building's rules and regulations to address social distancing and other COVID-19 related security protocols. Depending on how the original lease was drafted, a formal amendment to the lease may be needed before a landlord can institute such changes without risk. Doing so without a lease amendment could create a landlord breach and give rise to certain tenant rights or defenses. Before moving on to the tenant's perspective, I want to pause for a note to the landlords out there. If you do not wish to engage in lease negotiations with your tenants and instead want to seek judicial enforcement, know that in many jurisdictions, including the entire state of Florida, the eviction process has been temporarily suspended. With that said, let's move on to the next slide and consider the tenant's perspective. First, the tenant should seek a waiver of certain landlord remedies relating to any tenant defaults caused by COVID-19. The obvious one here is late rent payments, but tenants should also consider whether they might have already violated any non-monetary conditions set forth in the lease. In a similar vein, a tenant should review their lease to understand the applicability of other lease covenants impacted by COVID-19 and request appropriate waivers from the landlord. Another item to consider is that there may be unpaid tenant improvement allowance owed or coming due from the landlord in the future. The tenant might be able to apply such funds to current rent in order to avoid paying interest on the deferred rent. Also, some tenants have found that they need increased or additional building services or security measures from their landlords. Tenants should think about their short-term and long-term needs during these lease workout negotiations. A tenant should also think about the effect that increased building services and security might have on operating expenses. These operating expenses are typically passed through by the landlord, and in some circumstances, a tenant's share of operating expenses could go up significantly in the future. I suggest tenants try to seek protections against that now. One item that is specific to medical office tenants is the potential need to alter the premises in response to COVID-19. If you expect such a need, seeking the landlord's consent as part of the lease workout will save time and future headache. As we finish up, I would be remiss if I did not mention compliance with the Stark Law and anti-kickback statute. Although the Department of Health and Human Services and the Office of the Inspector General have issued COVID-19 waivers for certain financial relationships, medical providers engaged in lease workout negotiations still need to take care to ensure compliance. That's the end of my presentation. Before we move on to the questions, I'd like to thank Advent Health for putting this together and for allowing me to participate.
Thank you, Andrew. Such meaningful information. I like how you attacked both from the landlord side as well as the tenant side. I would imagine we have a nice mix of both on the call this evening. One question for you. I want to touch back on a comment you just made on the building services and security during the pandemic and the effect on operating expenses. And you made a comment about perhaps the tenant should take action now. Can you unpack that a little bit further? Would you just recommend a direct conversation with the landlord as to how they might anticipate that, getting that in writing? Can you elaborate on that for us?
Sure. Well, I think the first place that you're going to want to look is your lease provision and how it deals with operating expenses. There's a lot of different ways that's divided up. Some may already have caps that protect them, some may not. there may be certain things that can be included, certain things that cannot be included by the landlord. So trying to first understand what can and what can't be included is important. If you're engaged in sort of these kind of negotiations with your landlord, and especially if you're expecting that your landlord adds a lot of additional protections, security, other things, those obviously come at a cost and will likely be passed through. So, I suggest a conversation with the landlord as to what they can do to sort of protect the building tenants from seeing those increases right away. Again, sometimes you can get a cap, although landlords obviously aren't very inclined to do that. But there's generally, something that can be worked out. And at the end of the day, having a conversation with your landlord is the first place to do it.
Wonderful. Thank you for the clarity. I'm going to pause just for a minute to see if any other questions come in for Andrew before we move on to our final topic. Okay, thank you, Andrew. Last but certainly not least, we have Rachel. Rachel, welcome.
Hi, thank you. Thanks for having me tonight. All right, we have quite a bit of information relating to the Families First Coronavirus Response Act and the 2 employee leave laws that came out of that particular act. I'm going to cover the highlights and basic information regarding the 2 leave laws, and then go into some information that is important to help the practice, the business, make sure that they are documenting everything that they need to document so that they can comply with their obligations under the law, but also recoup the money where possible, and to avoid litigation in the future, potentially for alleged noncompliance. So the first slide identifies the titles of these leave laws. We have the Emergency Paid Sick Leave Act, and then the much longer title is the Emergency Family and Medical Leave Expansion Act. Sometimes I refer to them as COVID-19 sick leave or COVID-19 FMLA leave, but what's important is what these acts require. On the next slide, what we have done is identified the 6 qualifying reasons for COVID-19 paid sick leave. Importantly, both of these laws, the COVID-19 paid sick leave and the COVID-19 partial paid FMLA leave, apply to employers with fewer than 500 employees. So the Congress considered these to be small employers for purposes of these leave laws. The 6 qualifying reasons for COVID-19 sick leave, it's for employees who are unable to work or telework. So if the employee is able to work remotely, they would not qualify for the leave. But if they cannot work, then they can take paid sick time if they are subject to a federal, state, or local quarantine or isolation order related to COVID-19. That is full pay, subject to a cap that we'll discuss in a moment. If they have been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19, again, that is full pay leave subject to a cap. And if the employee is experiencing symptoms of COVID-19 and seeking a medical diagnosis, and that is also full pay subject to a cap. These first 3 reasons relate to the employee themselves. Additionally, if an employee is caring for an individual who is subject to that federal, state, or local quarantine or isolation order, or if the individual has been advised by their healthcare provider to self-quarantine, then your employee can take sick time, paid sick leave, but it is 2/3 of their pay, subject to a cap. If the employee needs to care for the employee's own son or daughter because the school is closed or the daycare is closed or the nanny or other child care provider is unavailable due to COVID-19, the employee is eligible for or entitled to paid sick leave at 2/3 pay, subject to a cap. And then there's a catch-all provision that we don't know exactly what it means yet because it hasn't happened. The Secretary of Health and Human Services has an opportunity to identify other conditions in the future through regulations that would qualify an employee for paid sick leave. Importantly, the child care provision under 5, we're going to come back to that as it pertains to whether an even smaller employer is required to provide paid sick leave for that purpose. Son or daughter in this case is also defined to be it can be the biological child, adopted child, foster child, if they're a legal ward of the employee, or stepchild, or if they are over the age of 18. In this case, they have to be under the age of 18. But if they're over the age of 18, but the child cannot care for himself or herself because of a disability, and their school or provider is unavailable because of COVID-19, then the employee could take leave. Next slide, please. So how much leave must we provide? Full-time employees are entitled to 80 hours of paid sick leave. Full-time in this case means that the employee is normally scheduled to work 40 or more hours per week. But even if their normal work week is more than 40 hours, they're still entitled to only 80 hours of the paid sick leave. It doesn't go up. Part-time employees are entitled to the number of hours that they normally work over a 2-week period. So the word average here, if they have a normal set schedule, then it's whatever their schedule is for a 2-week period. If they work 37.5 hours per week, then it's 37.5 times 2. If they are a variable hour or they're part-time but it fluctuates, that's when we use an average, but we average over the past 6 months, a daily average over the past 6 months, and then we multiply that number by 14. So it does get technical. Definitely make sure you're calculating it correctly if you have a variable hour part-time employee who needs paid sick leave. And how much is this going to cost? An employee using COVID-19 or emergency paid sick leave for those first 3 reasons that have to do with the employee's own situation. You know, I cannot work because I am subject to a quarantine or isolation order, or my healthcare provider has recommended that I self-quarantine, or I am experiencing symptoms and I need to go get a diagnosis, then it's 100% of the employee's regular rate of pay, capped at $511 per day and $5,110 in the aggregate. An employee using emergency paid sick leave for the other 3 reasons relating to their need to care for another individual, for their son or daughter whose school or daycare is closed, in that case, it is 2/3 of their regular rate of pay, capped at $200 a day and $2,000 in the aggregate. The federal government will reimburse the employer dollar for dollar for the sick leave via tax credits, and we'll talk briefly about that after we cover the family and medical leave portion. Next slide, please. So the Emergency Family and Medical Leave Expansion Act, so let me go back for a moment. The sick leave, that applies to any employee of the employer, whether they are full-time, part-time, seasonal, whether you hired them yesterday or whether they are your longest serving employee. Every employee of an employer of fewer than 500 employees is entitled to take emergency paid sick leave for one of the 6 qualifying reasons. The Emergency Family and Medical Leave Expansion Act covers any employee who has worked for the employer for at least 30 days prior to the first day of leave, and they're unable to work or telework because they have to care for their son or daughter whose school or daycare provider is closed or unavailable. So it's a very limited reason. Unlike traditional FMLA, which applies only to employers with 50 or more employees within a 75-mile radius. And there's all sorts of qualifications for both covered employer and covered employee under traditional FMLA. Here, Congress has expanded the FMLA to apply to all employers with fewer than 500 employees and to any employee who has worked for just 30 days, the 30-day period prior to the first day of leave. And the qualifying reason for this purpose is just to care for the son or daughter whose school or daycare is closed. It's up to 12 weeks of leave. It does run contemporaneously with traditional FMLA leave. So if you have an employee who is on traditional FMLA leave currently because they had a baby or they're recovering from surgery unrelated to COVID-19, then they might not have up to 12 weeks available to them now for this purpose. So figuring out how much COVID-19 FMLA leave an employee might have available to them is a bit of a word problem in math, depending on whether they have already taken traditional FMLA leave in the previous 12 months. Going forward, if they have to take it in the future, there's important record keeping to make sure that you know how much leave an employee has available to them under this new leave law. How much FMLA leave is an employee entitled to take for this specific purpose, to care for the son or daughter? It's up to 12 weeks, but is it paid leave? Normally, traditional FMLA leave is unpaid unless the employee has traditional vacation or other paid time off benefits available to them through their employer that they can either choose to take or their employer might require them to take to substitute an otherwise unpaid FMLA leave into a paid leave. This is different. The first 10 days or 2 weeks of the COVID-19 leave is unpaid. However, the employee can choose to use the emergency paid sick leave if they haven't already used those 80 hours for some other qualifying reason. They can choose to use the emergency paid sick leave, or they can use other paid leave benefits that they already have through normal employment. Note, however, if they're going to use the emergency paid sick leave to get paid for some or all of those first 10 days of the FMLA leave, that is only at 2/3 pay. If they are using any of their normal accrued vacation or other paid leave benefits in the ordinary course, that's going to be at 100% of their pay because that's their regular paid leave that they have earned through their employment. And employers are specifically not permitted to change or terminate any of their current normal vacation, sick, other PTO benefit policies. The intent here is to provide additional leave to employees in the COVID-19 crisis and not to touch other paid leave policies that employers currently have. After the first 10 days, then an employee who needs the leave to care for their son or daughter whose school or daycare is closed can take up to 10 weeks for the 12-week total of leave, but now it is paid at 2/3 the employee's regular rate of pay. And that is capped at $200 per day and $10,000 in the aggregate. The federal government will reimburse the employer dollar for dollar via tax credits. It's important to note that if you have payroll protection program funding, you may not use those loan proceeds to pay for the emergency paid sick leave or the emergency expanded family leave, because that would be double dipping, because you're going to get reimbursed for your leave dollars through payroll credits later. So it's important in your record keeping, whether you use an outside payroll company or you're doing it internally, to set up new buckets for emergency paid sick leave and for this emergency family and medical leave, so that you can easily claim your payroll tax credits later for having provided the leave, And also, if you have a PPP loan and you have to show that you use those loan proceeds to pay for employee benefits or payroll, including traditional vacation that you normally offer or other paid leave benefits, you can show that when you paid the employee, it was either out of this bucket or that bucket. So one is reimbursable through tax credits, the other is going to be part of your forgivable loan, right? So you want to be real careful to identify how you paid your employee for their time off from work. Which bucket does it come from? Both of these laws expired December 31st, 2020. So that is the time frame that an employee can take the leave. It is for emergency paid sick leave, it's just one bucket of 80 hours. If they use it up, then they're done. They might divvy it up. They might need a few hours for one qualifying reason, a few hours for another qualifying reason, but once they use the 80, that's it. The FMLA leave, again, it is 12 weeks maximum. That's it. If they need traditional FMLA leave for another reason, then that factors into the 12 weeks as well. Next slide, please. Congress did provide for a healthcare provider exclusion. In the Act, it says that an employer can exclude an employee who is a healthcare provider or an emergency responder from providing leave under these laws. However, the Department of Labor, in their regulations, expanded the definition of healthcare provider, much to Congress's chagrin, but these are the regulations that we have, so it's what we have to live with, where a healthcare provider is anyone employed at a doctor's office, hospital, healthcare center, clinic, medical school, local health department or agency, nursing facility, retirement facility, nursing home, and the list goes on, and it even goes beyond that to people who are providing services to those sites, even if they're not an employee. An employer of a contractor could potentially claim a healthcare provider exemption. Next slide, please. And it's not a requirement. It doesn't mean that a healthcare provider under that definition is automatically exempt. They're automatically covered unless the employer chooses to exclude the employee. And the Department of Labor did caution employers to be judicious about who they're going to exclude, keeping in mind the purpose of these leave laws. Under the small employer exemption, and I realize we're coming up on time, so we'll end in a moment. Under the small employer exemption, that is for even smaller employers of less than 50 employees. And the exemption from providing leave under the Emergency Paid Sick Leave Act is limited only to providing leave for someone who needs to care for their child whose school or daycare is closed. So the exemption under sick leave is just for that one purpose, and then of course for all of the FMLA because they have to care for the child whose school or daycare is closed. Small employers must still provide emergency paid sick leave for each and every one of the other 5 qualifying reasons. This means that all employers, including small employers, must still post the Department of Labor's notice about employees' leave rights. If a small employer wants to claim an exemption from providing leave, then they must make an affirmative determination justifying the exemption and detailing why providing paid sick leave for the purpose of caring for a child whose school or daycare is closed or providing this expanded FMLA leave will jeopardize the continued viability of the employer as a going concern. You don't submit the documentation to anyone, but you make the determination and keep your documentation in case you need to claim the exemption in the future. And the reason for that is that employees do have a right to make a claim if they feel that they were not provided the leave that was supposed to be provided to them. It is similar to a claim for unpaid wages under the Fair Labor Standards Act. So employers want to make sure that they make these decisions correctly and document them. Next slide, please. A few comments on other cost-saving measures, such as reducing schedules and compensation. A helpful component is that if you have exempt employees and they're only being paid 2/3 of their pay for providing leave, but they're working part of the week at full pay, but then they're not working other parts of the week because they've taken sick leave at 2/3 pay, or they're taking intermittent FMLA leave at 2/3 pay, that does not destroy the exemption from overtime. Normally, we have to pay an exempt employee, their full salary if they work at all during the work week, subject to a few exceptions. But here, you can reduce their pay to the 2/3 because Congress said so. So you don't have to worry about destroying the exemption for providing 2/3 pay to an exempt employee. Definitely communicate with your employees in advance about what is happening, about any leave, have good record keeping, but certainly throughout this crisis, all communication is important. Be aware of the impact of reducing schedules and compensation on employee benefits. Check with your broker or agent about your health insurance policy and see what it might say about employees who are now working a drastically reduced schedule or who have now experienced a significant cut in their compensation if salaries are reduced across the board, for example. So there could be an impact on their benefits. Employees who are still working, but working a much smaller schedule or whose compensation has been reduced quite a bit may still be eligible for partial unemployment benefits. Here in Florida, we call it reemployment assistance. So I know there are challenges with people applying for those benefits now, but they can still be employed and still be earning some money, but potentially qualify for some benefits because of a change in schedule or comp. Next slide, and actually the next slide after that. Again, furloughs, layoffs, reductions in force. Again, be mindful that if there is a furlough or a layoff, then it could trigger an opportunity for an employee to make changes to their benefits and then possibly be eligible for COBRA. If you're a particularly larger employer, you might have a duty to provide a WARN notice, although the unforeseen business circumstances exception might apply in this particular situation. The selection process, unless you're closing down and sending everyone home, whether it's a furlough or whether it's a termination, be mindful of who it is that you are selecting to not work. Look at the demographics, see who has taken FMLA leave recently, regular FMLA leave, or even people who are taking their emergency paid sick leave or expanded FMLA leave. So if you're selecting 10 out of 20 employees to furlough, those 10 shouldn't be the only ones, for example, who have all recently taken protected leave. So that's a drastic example, but just be aware of who it is that you are retaining and who it is that you're sending home, whether it's a furlough or a termination, so that you can defend against a claim of discrimination or retaliation should it come. And I can tell you they are already coming. And then finally, of course, there's eligibility for unemployment comp or reemployment assistance. One challenge, though, and I'll leave with this because it's a bit of a question mark. If you furlough your employees or even terminate them, but if you furlough them and they're not completely terminated and they're collecting reemployment assistance or unemployment, and now you have your PPP loan, so now you're going to pay them. Some folks will find that they are actually earning more through unemployment now because of the federal supplement to those benefits than they are when they're working. And so there's been some pushback from employees saying, well, we don't want to come back to work because we're actually making more now. And that's not taking the long view, certainly from an employee perspective, and they're not thinking about perhaps the impact on their insurance benefits. But that is an issue. But yes, you can tell your employees you need to come back. So there's a lot of material, but again, I think the most important thing for all employers at all time is record keeping, documenting the decisions, making sure that leave is put into the correct bucket so that you can make sure that you are still using PPP funds for the purposes that those are intended, and that you are able to claim your tax credits to get reimbursed for the emergency paid sick leave and the expanded family and medical leave. So that is it for now. So thank you. And if you have any questions, I'd be happy to answer them.
Rachel, thank you so much. And take just a moment to thank all of our 4 speakers this evening. Some really great content. A couple of logistic items before we close. One, this, if you're able to stay, we've had a fair number of questions come in. So for those who are able to stay, I know we're a little over. For those who are able to stay, we certainly welcome you to, and we'll do our best to get you those items, get through the questions as we can, assuming our speakers stay with us. We have recorded this event and we will post it, and we will also be happy to share slides for those speakers that had slides. So if you would like either of those materials, either the recording or again the slides, feel free to email Ross. You'll see his contact information on the screen, and we'll be happy to get you the information. For the speakers that are able to stay, I know we've asked a lot of you already, so if you're able to stay, we'd be even more in your debt. But Rachel, a question came in for you during your talk. In the beginning, you referenced the caps for paid sick leave. Can you go deeper in what the caps are?
Sure. So the caps are, it's the maximum amount of paid leave that an employer has to provide to an employee for whatever that leave purpose is. So, for example, if an employee is taking emergency paid sick leave because the employee is experiencing symptoms and needs a few days off to go get a diagnosis. So let's say 3 days, 24 hours so 24 of the 80 hours are going to be used for emergency paid sick leave. The employee is entitled to full pay at their regular rate, 100%, but it's capped at $511 per day. So depending on the employee's rate of pay, as a practical matter, they will they'll either be paid their full rate, or if they're a more highly compensated employee, they are not actually going to be paid 100% because it is capped at the $511 per day, or for all 80 hours, $5,110 in the aggregate.
Excellent. Thank you. An additional question. Can you please explain the relief fund payment conditions?
Relief fund as in, well, payroll protection program or reimbursement through tax credits for providing paid leave. So speaking to the latter, so I always recommend that employers speak to their tax advisors and accountants on how to claim those tax credits. But what the legislation clearly provides is that the government is going to reimburse employers 100% for the paid leave provided under the Emergency Paid Sick Leave Act and under the Emergency Family and Medical Leave Expansion Act. Of course, it's a delay. You know, you have to pay the money now out of your employers have to pay now out of their current existing funds, and then the reimbursement will come later through the tax credits. But the mechanics of the tax credits, I need to defer to the accounting professionals for that.
A follow-up to that is that the question is it a grant or is it a loan from the government?
Well, the paid sick leave and FMLA, it's neither, because the employer has to lay out the money at the outset and then affirmatively claim the tax credits. And while slightly related to that, if an employer, for employees who are taking leave that gets them 2/3 pay, can the employee use their normal paid leave benefits to top it off to get 100% of their pay? And yes, if an employer could allow an employee to do that, but the employer cannot get reimbursed for the topping off because that's the employee using their normal paid leave benefits. So to confuse things further, an employer could use their PPP loan for providing normal pay under normal paid leave benefits, but not to provide the paid leave at the 2/3 pay. So I probably shouldn't have said that because it complicates things further.
Thank you. We're going to go back up to some questions that came in. Andrew, during your talk, I don't know if Andrew's still with us, but Andrew, during your presentation, and it may also be a question for Anne, if you're still on. The question is, can operating expenses such as pass-through fees, condo fees, and other building operating expenses be used for the PPP expenses?
This is Andrew. I am on. I think that's probably more of a question for Anne. I know the Act basically says rent and doesn't do a great job of defining it, but I'm guessing the SBA has provided a little more information or hopefully will provide more guidance as to what qualifies as rent.
I'm not sure that we have Anne. Do we have Anne still? Okay, for the person that posed that question in the question and answer section in Teams, since it's coming through as anonymous, I would encourage you please to email Ross, whose contact information is on the screen here. And he can connect you with Anne and get you the feedback that you're looking for there. Thank you, Andrew, for taking a stab at that one. In the interest of time and to be respectful to our speakers, we'll take one final question. And Rachel, it's back to you if you don't mind. Do employers of businesses with less than 50 employees have to financially cover? Oh, I just lost the question from the screen. I don't know where it went.
Well, I can take a stab at
that was me. I have it here. I apologize. Okay. Do employers of businesses with less than 50 employees have to financially cover the emergency leave of their employees, or are they exempt?
They can claim an exemption. So employers with less than 50 employees are by default covered employers under the Emergency Paid Sick Leave Act and the Emergency Family and Medical Leave Expansion Act. The small employer with fewer than 50 employees can affirmatively claim an exemption from providing the family leave portion and from providing the 80 hours or 2 weeks of paid sick leave only for the purpose of providing care for a son or daughter whose school or daycare is closed. But the employer to be exempt, for the employer to affirmatively claim the exemption from providing leave for the child care purpose, they have to make a determination that providing the leave would jeopardize the financial stability of the business as a going concern. And they have to document the reasons why they have reached that conclusion. And then they don't do anything with the documentation. The Department of Labor does not want anyone to send it to them. So while the regulations don't flesh out the issue completely, what it seems to mean now is that the employer makes that determination. Then if an employee of a small employer requests either sick leave to care for their child who's school or daycare is closed, or they request the family leave to care for their child whose school or daycare is closed. The employer then will deny the leave, citing the small employer exemption. And then, if the employee seeks to enforce the rights they believe they have, then the documentation the employer has prepared and kept internally will be used to support their defense. But yes, there are some ambiguities about, well, is it just the employer's decision? If they, is a judge or the Secretary of Labor at some point in the future going to say, we disagree with your determination that you were exempt? We don't think that providing the leave would have jeopardized your business as a going concern. These are some of the unanswered questions.
Thank you. Thank you, Rachel. If whoever has control of the slides now, if you could go to the last slide that speaks to next Thursday's webinar. I mentioned this in my opening comments, but next week's webinar will be geared towards physicians' spiritual and mental well-being. We have some fantastic speakers that I'm incredibly excited to hear their discussion items for us. I would really encourage you all to join that as you're able to. I know you'll find it very worth your time. I want to take a final moment to thank our panelists again and to thank everyone who joined, as well as the team who put this all together. It was a lot of work, and the feedback coming in so far has been very positive. So thank you from all of us, and everyone have a great evening.
Thank you.
Thank you.
Thank you.